All attendees are in listen-only mode.
Hey everybody, Preston Bryn here with our Trader User Group Weekly Roundup. This is for the trading week ending September 9, 2016, and what a kickoff to the month of September we've had. Hey everybody, I'm back from my European tour. Had a lot of fun over there for about 6.5 weeks. Visited a couple of really great countries. And now I'm back in full throttle, full swing here back in the United States. What I've got here on the screen is the S&P 500 E-mini futures. I've got a weekly chart on here, and I just wanted to take a step back for just a minute, and let's just take a look at a couple of things here. As you can see, since 2009, March 2009, we've been in this huge move to the upside. And now it's starting to, and this is a very hated bull market. I will admit, since 2009, there's since a lot of money was decimated in 2009, a lot of money is on the sidelines still. And we've had a couple of scare the children moments with a couple of moves down. One here, here, the Brexit right there, and now the big question everybody's got right now is what's going on here with Friday's move. Well, our members in our group, we started loading up on volatility this week. In fact, I was telling folks that vol is just, you've got to step in front of it and you got to start picking up vol, go long volatility. And that's what we were doing, especially in the futures market. And we were paid off on Friday. Now, no one knows what the market's going to do day to day, and certainly Friday we had this huge move to the downside. I mean, the E-mini futures moved down. I think it finally closed at 56.5, and huge move down. And then we had the Dow futures down 427 points. And the SPX, the cash index, was down 53, almost 53.49, so 53.5. So really a huge day. The other thing we saw is volatility coming back into play, which I know makes a lot of options traders very happy. But let's just kind of break this down and kind of take a look at, what can we expect here. Now, we've got a couple of key events coming up. Not next week, but the week after, with the Bank of Japan Central Bank meeting, and of course our very own rat brain government body of the FOMC coming out. They're going to be talking about will it be a rate hike? Will there not be a rate hike? Do we think there'll be a rate hike? And again, as usual, they like to step in front of the podium and voice their own opinion. And some people of the belief that this past Friday's move down was because a few got out there, one in particular, and said that they could see not one but several rate hikes. And then other people are saying, well, it's because Super Mario Draghi over at the ECB this past week did not do anything in the way of stimulus. So, it doesn't really matter what your cup of tea is, whether you want it with sugar or without. Right now, the markets are going to kind of pick their direction and go. I believe this Friday move was not a lot of new shorts coming in. It was just simply profit taking. Okay, if you look at the percentage of stocks that are in the S&P 500 that are over their 50 EMA, we've been seeing bearish divergence moves in that. I've been telling our members this for about I would say maybe about a month, that the 50 EMA percentage is getting lower and lower as we move higher and higher. However, the percentage stocks in the S&P 500 over their 200 EMA is actually moving stronger. So that tells us, at least gives us a higher probability that any pullback here, we're going to see some consolidation, certainly leading into the FOMC. Now, I wouldn't have predicted a 55-point plus move to the downside on Friday, but we'll look at the daily chart in just 1 minute. But if we look at this chart that you see right here, what's really interesting about this is if we really come in, there's a couple of key things that I wanted to show here on this chart. And if I back out just a little bit here, just so that you can see, in the scheme of things, this move Friday was really not much of anything, right? But if we look at this, there's a band that we've been in for quite some time. And the markets need to make this decision on this band. And if I put it in here like that, that's the band, right? In fact, I could probably come over here and include this piece right here as well. So that's the band that we've been in. And by the way, this goes all the way back here to the fourth quarter of 2014. Okay, so we've been in this very wide range here, very wide range. And we extended ourselves here, but this right here was former all-time highs of 2134, and it took us over a year and a half. You remember all the press, all the headline news that it's longer than what, several decades to be able to break out to a new high kind of thing. And it was at 2134. And then when we finally broke out, people were going, okay, yeah, now we finally broke out. That's our breakaway move. In our group, and what I was telling our members, I said, look, the easiest call from a technical perspective, it doesn't mean it's going to happen, but the easiest higher probability call would be for, at a minimum, a retest of 2134. And that's what I was calling for. I was also calling for a high of around 2200 for those of you that are following me in my weekly roundup, these free sessions here that I put on for the weekend. You guys know that I've been calling for that since the post-Brexit vote back in June 23rd, 24th timeframe. I said we'll probably come up to around the 2200, and we missed it by about 7 points, 7.5 points, and then we pretty much gave it up. But I do not believe we're going to have a lot of downside action. Okay, we may have some follow-through action on Monday, but I don't see a lot of downside action continuing, at least up to the FOMC. At least looking at the way the price action was moving on Friday, it did not appear that way to me. I'll show you what I mean in a minute. You can also see here there are no divergences on the indicator here, the MACD. As those of you that follow me very closely also know, I fine-tune my MACD with the setting 6.18.6 rather than the out-of-the-box setting, and I marry it with my 412 crossovers here. So by tightening the EMA and tightening the MACD, it makes it a little bit more sensitive than the normal MACD setting. So it really serves as a really good early warning if things start to get out of hand, primarily with bullish and bearish divergences. We had no bearish divergence here, so that says that we could come down a little bit more, but I think the selling, we may have a little selling momentum, like I said, Monday. We'll know Sunday night when the markets open and then going into Monday. But we got to have the Asian markets catch up with us because remember they were closed when all of this down action was going on Friday. So you'll probably see some selling when markets open, probably a continuation or at least Asian market selling, trying to catch up with the U.S. and European markets. But I do believe we're going to have this down move arrested a little bit, and then there might be some consolidation. Vol is going to remain high going into the FOMC. Keep in mind next week is also triple witching. It is the monthly option expiration. If you haven't rolled already, you should be looking at that. We got futures expiring, we got quarterlies expiring, we got the index options rolling over. In triple witching, the tendency of the market generally in the latter half of the week primarily is for volatility to come in, not go higher. But that's in a normal market. We got the Feds coming up, we got the Bank of Japan coming up, so we could have a perfect storm that if the Feds come out more hawkish, let's say the Bank of Japan doesn't do anything or they don't do what they say they're going to do because that's been their past history, then we could see, another 100-point sell-off and before buyers are willing to come back in and pick things up again. Okay, that would take us down into the, 2050 to 2000 area before buyers are willing to step in. If that's the case. So also from a seasonality standpoint, September is the month where it tends to be a lot more volatile. So we've got a lot of things here from a trader perspective, from a swing trading perspective. All you got to do is watch the key pivots as we always do, and it keeps us on the right side of the market. You're not going to find, unless you get lucky, you're not going to pick the top, you're not going to pick the bottom, no matter what time frame bar you're trading, but you'll be able to get with the trend if the trend is going to be a lasting one. So this is kind of what I'm looking at right here, right now in the S&P 500. So that this is going to be kind of our focus here. Now, if we take this down to a daily chart, all right, so let's just zoom in a little bit, and you can see the damage here, right? We came and we took out the red line is the 50 EMA, the yellow line is the 200 EMA. So the 200 EMA is going to act as a kind of a stopgap support for us, besides the psychological 2100 number. But you can see here this volume over price, right? And it's this blue bars coming in off the left-hand side of the screen. There's a lot of volume in this area here, which is going to act as a firming support area for the price action. And you can see it's fairly wide. There's a little bit of volume right here, and then there's a little bit of volume right in this area here, because obviously we were trading in this tight range for some time. So this is going to act as an overall catch basin for the market, at least for the probably for the month of September. Now, depending on the Feds, obviously can move us over the edge. If we go over the edge, we'll challenge the Brexit low right here, and if that's taken out, then we're going to go for a ride, folks. So these are going to be the key pivots that we're going to be following. I'm going to, at this point in time, expect the 200 EMA, which is at the top of this kind of catch basin down here with all this volume. I'm going to expect this to hold up for us. That's at 2083. So yeah, that does take us below the 2100 level. The E-minis closed the day on Friday at 2114.50. So it's only 14 points. I could see the momentum taking us right below the psychological barrier of 2100. That'll trigger some more selling because, a lot of rat brain traders will get nervous, and that'll push us down maybe at slightly below the 200 EMA, and then buyers may step in, at least pre-FOMC meeting. So these are some of the things that we have in store for us next week. Now, Monday, the only thing that's happening is we've got a Fed official that's speaking. He's known as being very dovish, so he could, put a halt to this down move if that was the cause, and provide a little bit of a bullish respite. But we can't really rely on that. So if I put all of my indicators and lines on the screen here, let me just do that. Now you can see this big area here was drawn off of weekly pivots. This was our resistance point, and sure enough, we came up. I missed it by just a few points. All right, we hit 2191.50, and I missed it by 8 points, something like that. 8.5 points, and now we're hitting a little temporary S1 support right here. But you can see the former all-time highs here. If I just let's widen this out so you guys can see it. You can see right in that area here. Here are the former all-time highs that it took us over 400 plus days to recapture. So that was the first most easy call from a technical perspective, from a probability perspective. Yeah, anything that serves as a very difficult resistance area. If you blow through it to the upside, the odds favor, a retest of that area. Now we've retested this area. In fact, we've gone back through it again. So what this means is this area now, all right, the 2134 area, is going to become a key line for us. Okay, if you think about the psychology of this, if you take and if we just draw the line here, right, let's assume that is a key line, that price action, it comes up, it just can't get over it, and it spends a lot of time hitting it, right, and it does one of these things, and then finally it goes up over, right. Well, usually the first breakout like that is just the bulls, what they want to see is a back test, a retest, and have it hold and then go higher. And then in that next higher move to take out that prior pivot high to continue higher. So that'll commit more longs to the market. However, what we're in right now is here's the former all-time highs. We've done the retest, and now we're down in this area here. We actually closed down at the low of the day, or almost right at the low of the day. So we're down in this area here. So now what we've got to do with this line here at 2134, which has just been a huge resistance point for us for a long time, for record decades, as far as taking out all-time highs like this. It took us that long to do. You know, it was in the papers. Hopefully a lot of you guys read it. But anyway, even if you didn't, you can just see the charts and you can follow the action. So now we're down below this area right here. So I would expect at some point, maybe even before the FOMC, we're going to come up and have a retest again. Okay. We may come down a little bit lower, but we may come back up. The odds favor up, and let's do a retest again of this 2134 area. Okay. Now, on that retest, excuse me, that's going to be the moment of truth. If we retest and move through it and hold it on a daily bar, daily time frame, and then we come back and retest and then go back up again, that's going to be a bullish price action on the chart, and you'll see more longs committed to the markets. If we do a retest and we fail and we come back down and take out the prior pivot low, that'll be a signal for more shorts to come on and probably more profit taking from what we've been in for the past 3 years or so. Okay, and you'll see more people going to cash. Not as much people entering shorts, as just profit taking for now, unless we get down a little bit lower. Okay. So this is what we're going to be watching for over the next 2 or 3 weeks as we get through the Fed and the Bank of Japan announcement. Which way do I think it's going to go? I have no clue. I mean, you cannot predict what these monkeys are going to do at the FOMC. You just don't know what they're going to do. Aunt B is going to put her baked pie in the window, and hopefully the boys like it. But they may not. You know, they may stick a finger in the pie again, like I said a couple of weekends ago. So anyway, this is kind of where we're sitting right now on the S&P 500 E-mini futures. And by the way, once we hit that high up here, I was telling our members that, you know, we got a bearish divergence here. So be prepped. And that was back in about the 3rd week of August. Now, obviously, I did not expect a 55+ point move. I expected a move down probably into the 2152 area. Okay, that's where I expected, right around the 50 EMA. But obviously, the markets are going to do what the markets are going to do. And there was just a lot of money that was made, right? If you think about it, let me just take this back off the screen again and just give you a little bit of food for thought here. Let's just clean the screen up again for you. And if we come down here and let's just add a Fibonacci off the Brexit lows, right, like that area there. All right, there we go. There's the Fibonacci off the Brexit lows. See anything familiar there, guys? Well, the first thing you're going to notice is right in that area there. It is just a natural stopping point, which also happens to be on my chart before I took all my indicators off, exactly what I called our S1 zone on our daily chart. So this is kind of where we're holding up here. The 200 EMA is right around the 50% retracement. Remember, I was going long and I was suggesting for folks to go long right in this area here off the Brexit vote. So just assume a lot of people went long this area here, and then all of a sudden when it started coming down like this, all these people that were in with money right here, all right, they said, oh crap, I got to get out. So hence this big move down. So we're giving up some of the people that played that Brexit move to the upside. And then there's some longer term money that's probably just cutting some positions right here. Keep in mind, we've got 2 weeks till the end of the quarter, so there's going to be some window dressing as we come into the end of September as well. So there's a lot of factors coming into bear here, okay? I still believe that I don't see us going much lower than this 2087 area before the FOMC. I may be wrong, but the charts don't seem to indicate that. If we do, then I think buyers will come in and push it back up into the FOMC meeting. All right, I don't think there's going to be a lot of new shorts, except very short-term players just coming in and trading, swing trading a short position. But I don't see a lot of big short positions being taken at this point in time prior to the Bank of Japan and the FOMC meeting. All right, so this is kind of how I'm reading the markets right now. Just a couple of other key things that I wanted to show you on the charts here that, just really we had some damage here. Let's look at VIX. VIX finished the day at 17.5. Look at that move, okay? We hit the low of 2016 on August the 9th, and then we just blew in one day all the way up in this area here. Now, we were going long volatility before Friday. I think I had posted with my group to go long volatility on Wednesday or Thursday of this week because it was just getting too quiet and we're getting too close. Now, keep in mind the FOMC, they're by law here in the United States, for those of you that are watching this in other overseas markets, by laws here in the U.S., they cannot get in front of the podium and say a word 7 days before Tuesday, the 20th. So that puts us down to the 13th. So they've got 3 days and then there's a quiet period. So don't be surprised if on Monday of next week, that's the last official day. Well, they love to talk on weekends too. Put a mic in front of their face and they're like any other politician. They shouldn't be, but they are. But they've got till the September the 13th to say what they want to say in front of the mic, and then they can't say a word. So we could have some more Fed speak coming out this weekend, but we've got one. None is scheduled until Monday. But I suspect some of them are going to be on the TV talking head shows Monday morning. And remember, this is part of the Fed arsenal. It's part of the ECB arsenal, part of the PBOJ, part of that's the People's Bank of China, or PBOC, and the BOJ, Bank of Japan, and Mark Carney and the Bank of England. All the central banks as part of their toolkit. They like to talk the markets down without taking any policy action. All right, and you saw an example of that, or an attempt of that this week with Super Mario, and Lundgren and a few others that talk about multiple rate hikes, right? So they talk the markets down. They send these guys out and they drag the market down to prep it when they do hike the rates. So, but you can see here we're now in zone 2. What is zone 2? Well, our members know what it is. And this is just percent of capital deployed for credit spreads. Typically kind of just a rule of thumb. I like to follow that. It will keep you out of trouble. The higher the volatility, the more you should be in credit spreads, meaning it kind of puts you in a mode of thinking more about selling vol when it's higher, selling premium when it's higher, and when vol is lower, you can get lulled to sleep in order to, and it forces you. A lot of traders just force themselves to create opportunities by selling premium, and they get overloaded here. So basically 25% of your capital, when it's under this in the green area here, should no more than 25% of your capital should be devoted to just selling premium. Basically down in this area here, you should be buying premium. And then as vol goes up, the mind shift starts to shift in your overall portfolio strategy. So we follow this and it works out very well for us. Now, if we look at the bond market is giving it up, okay? I mean, look at the bond market. You can see here on this daily chart, we really started this downward trend back here at the end of July. For the entire month of August, it's very deceiving, but we've got this 1, 2, 3 pattern here. And I don't think we're done yet. It's suggesting that we can move all the way down into the 150, low 150 handle area. Now, I got long TBT, and we've played bonds to the short side a little bit, but you can see here the way the bond market moves. Now, this doesn't look volatile on a daily basis, but if you put it on a 2-hour basis, the volatility becomes apparent, right? We're still moving in a downward fashion, But you can see here, and if you're short bonds, it's very hard to hold short bonds if the bond is down here and it's moving up like that. Then you end up getting out, the bonds move down, you go short, it goes up, and then it does one of these kind of things like this, right? We make these big moves from the top of the channel to the bottom of the channel. So all it is just a matter of cycling and timing your entries, okay? So, you know, we talk about this also a lot for our members. And then we finally broke this channel over the past few days, and the bond market just pretty much gave it up. I do believe that this vector, which is the rate of declination of the markets, it kind of measures, right? If you were to draw a straight line like this and then do that, you remember the old days with the degrees of slope, you know, and all that kind of fun stuff. So what it does is it measures the degree of bearishness, bullishness, or just a sideways market. This is a downtrending market, but it's a volatile downtrending market in the bond market. So we had this break here. I suspect we're going to move back up into this, and then we're probably going to give it back up again. So for those of you following along short bond or long TBT or short TLT, you know, you're probably happy right now. Now the real key, not the real key, but I talked about this Q4 of last year, was in the currency market. And if we look at the US dollar, and let's go back to the daily time frame here, the US dollar has been damn near impossible to trade. Okay, I mean, if you want to day trade it or 2 or 3 day trade it, is fairly simple to do, but trading it longer term is difficult to do because you know, ever since we hit our peak back in December of 2015, right, right at the beginning of or the end of December, I can't talk, the end of 2015 going into 2016, you know, the dollar's been in a downward move. And you would be thinking, well, why is that the case? Why is the dollar going down when we're the only country talking about taking stimulus off the table? All the other countries are talking about putting more on. In fact, they're going more negative. We got over about 13 trillion in negative yielding debt right now. And so you may say, wouldn't the dollar be a lot stronger? Well, yeah, no. And I'm not a conspiracy theorist, but I do believe the Feds and other G20 countries are working together to keep the dollar artificially low. That'll help emerging markets. It'll help the global economy. There are a lot of little minor factors at play here. We have coming up next month the official introduction of Chinese yuan as part of the SDR, the strategic drawing rights, STR for reserve currency. It's going to join, you know, several of the other currencies, but net longer term, it's going to have the essence effect of devaluing the US dollar. Okay, so our politicians are totally clueless, so they're not going to see it, and savers are going to get punished. Longer term, the dollar is going to go down. Short term, we can have spikes, but longer term, it's going down. I'm not a big believer in the euro either. I think that's a failed experiment, but you know, what the hell do I know? We've been in this very tight range here. I just don't think the euro is going to go anywhere. Over the next year or so, there's going to be trades to be made in it. But no, where our action has been a lot recently is in the British pound. The British pound has seen a lot of action. You can see from the Brexit vote right here. We were shorting this like crazy all the way down. It turned out to be a great trade. And now we're just forming this consolidated bottom right here, okay? I switched from short to long, got out, took profits, went long again. If we break a couple of key areas here, I'll probably just get back out. We could go a little bit lower, but I think longer term, the British pound is just severely undervalued. Remember, before the Brexit vote, Great Britain was the second strongest economy globally, if you looked at the economic data, behind the United States. And, you know, no one, by the way, is doing really well, but it was the second strongest, ahead of Germany, in fact. So Now with the Brexit vote, depending on how they negotiate their trade agreements, which I think they're going to do very well, I think the markets always overcorrect both to the upside and to the downside. And I think longer term, the pound is just going to be a place where we can make a lot of money. So we're going to be watching that in the future. The yen is going to be very interesting too, because we got also the Bank of Japan meeting coming up, and we're going to see the yen really break out of a range that it's kind of been in for some time here. We played this a number of different ways, but you can see right in this area here, if they do what they say they're going to do, you're going to see the yen break here and come down and test that pivot and then come back down into this area here. And that'll have a tendency to strengthen the dollar, which will then reduce some of the commodities also. Okay, so this is kind of what we're seeing here. There are a number of other things going on in the gold market. We've got a number of interesting developments here that I see coming up. In the oil market, we had a big, huge, we pretty much gave up everything that we did the day before in the oil market. We're looking at some potential trades here that I like. Obviously in the ag market with corn, I was telling our members here off of these lows here, we're going to be going long the ag market. We're in the silly season for gasoline and oil in September and October, whereas it tends to be a drawdown. And then obviously in the softs market, we've got some plays in there as well. So folks, I've got a lot of things going on. We have a lot of really interesting things that are moving around, a lot of moving parts. If you're not a member of our group, I highly encourage you to come in and check us out. Check the offer here. We got a lot of folks that are coming in. And we're having fun. You know, Friday was not a good day for just about everybody, but it's easily correctable and adjustable in trades. And for those of you, we were hedging our trades long with a lot of long vols, so that'll help out. I think we're going to find that bottom prior to the FOMC, but now where we go after that, as I said, these are the key pivots that we're going to be watching, okay? We're in this zone here, as I showed you, which also happens to be a perfect retracement on the fib levels off the Brexit lows. You can see the 2016 open price here of 2037. Folks, we're not that far away from that, okay? 70, 80 points away from coming back and just being flat for the year. And we could give it up if the Feds are a little bit more hawkish than people think. I think the Feds will probably end up being a little bit more hawkish. They'll probably not raise the rates in September, if you force me to guess, but they'll be hawkish, and then they'll bump the rates up. And then when they finally do bump the rates up 25 basis points, Yellen will get out there and say, we don't see another rate hike near term. The data needs to improve, and then you'll see the markets rebound and go much higher. Okay, we saw evidence of that the last time she spoke. So that's the price action I would expect. But no matter what I expect, we'll follow the key pivots and where the direction leads us. All right, everybody, have a really great weekend. And if you're not a member, come on in and join us. I think you'll have a lot of fun. Otherwise, catch you guys the following week. Ciao, folks.